Welcome to the Finance Masterclass series, and today's topic is four key things on a balance sheet. The webinar is divided into three parts. So, the agenda of today's webinar will be answering three questions. What are the three questions? What's on a balance sheet? We might have tried reading a balance sheet, we might have heard a lot of jargon and terminology that is on a balance sheet. All that jargon and terminology will be explained in layman terms in this first part of the webinar. The second part of the webinar is on why balance sheet is prepared. Why do we need a balance sheet? As a business owner or as a key decision maker in a business, why should you be learning about what's on a balance sheet, or why is that you should be referring to a balance sheet? And the final part of the webinar will be what to see on a balance sheet. What are the key things? What are the four key things on a balance sheet that you as a decision maker should know? So, this will be the agenda of today's webinar. Now, definition of a balance sheet. Many years back, in fact, more than 6 years back, when I first started to understand or get my head around the subject finance and accounting, the common definition that I came across for a balance sheet was the balance sheet is a quantitative summary of a company's financial condition at a specific point in time, which includes assets, liabilities, and net worth. It is a snapshot of a financial health of an entity. Friends, I know if I continue explaining balance sheet with so much jargon and terminology, after 5 minutes, I'll be the only presenter. So let's say hell with this definition for the time being, and let us try to understand finance from a layman perspective. I strongly believe finance is a common sense subject, so let us use our common sense to understand this subject. Some of you might be business owners, some of you might be thinking of starting your own business. Now, let us imagine you are a business owner. This is you, the business owner, before starting a business. Before starting a business, you had many ideas. You were excited with all your ideas, and the problem for you would have been which idea to choose, which idea you would choose to convert it into a business. And then you decided to start a business. Now, friends, to start any business, we need two kinds of capital. What are the two kinds of capital? Intellectual capital and financial capital. Intellectual capital is all about the know how, and financial capital is about how a business raises funds and how well it manages it. Now, this is something very important to understand. You are not your business when it comes to finance and accounting. I repeat, when it comes to business finance, you are not your business. Business owner is always treated separately from the business. And this is something very important to understand. And if you can make that distinction very clear, then it becomes very easy to understand balance sheet. Now, balance sheet is always prepared from a business perspective. From a business perspective, to start any business, as I mentioned, we need intellectual capital and financial capital. And financial capital is all about how business raises funds and how it manages it. When business needs money, it borrows. I repeat, when business needs money, it borrows. First, it borrows from insiders, owners, investors, and the three famous F. which are family, friends, and fools. And then business borrows money from outsiders. And mostly it will be from a financial institution like a bank. The main difference between insiders and outsiders are how they how willing they are to take risk within the business. Now, outsiders, they prefer to take less risk, very low risk, and they want a fixed return on their investment. However, insiders, they are ready to take high risk and they do not expect any fixed return. However, they would demand equal share in profit for the risk that they will be taking in business. If the business makes profit, then they expect the profit to be shared equally. If business makes a loss, they have they would have understood that they have entered a game, entered a contract where they will have to deal with it. That's the main difference between insiders and outsiders, the risk they are willing to take. Outsiders, they always consider the worst case scenario and they try to minimize the risk as much as possible, and on top of that they expect a small return on their investment. Now, let us see how this appears on a balance sheet. Again, balance sheet is prepared from business perspective, not from business owner's perspective. Looking from a business perspective, on a balance sheet, we have two headings: liabilities and assets. Friends, as I mentioned before, I am not a huge fan of using jargon and terminology. For me, liabilities are nothing but sources of funds. Where has the business sourced its money? And the money that it would have sourced, when it uses in acquiring something, then that would be considered as an asset. Let me elaborate more. This business has sourced money from insiders. It is called as capital. If there is more than one person in the business who has invested, then they will be sharing the capital. It is called as share capital. And this business has also borrowed money from outsiders, and they are called as loans. When the borrowed money is used in acquiring land, building, equipments, and so on, that's when it would be considered as fixed assets. Now, sometimes business will not borrow physical money, but it will borrow its kind. Before that, let me ask you this question: what are the different types of fixed assets in your business? Please type in different types of fixed assets in your business. Yes, some of you are saying land. Some of you are saying office furnitures. Yes. Some of you are saying equipments. That is correct. I'll wait for a few more responses. Yes, I agree. So some of the common fixed assets that we might have in our business will be land, building, machineries, office equipment, furnitures, vehicles, and so on. Now, coming back to the liabilities side, sometimes business will not borrow physical cash, but it will borrow its kind. Some of you are typing in saying you had some issues with the internet. Let me quickly check. Check, check. Are you able to hear me clearly? Okay, now it's fine. I think the internet just dropped out. Anyway, let me continue. Sometimes business will not borrow money, but it will borrow its kind. What I mean by its kind is sometimes business will borrow goods and services on credit terms. All the payables, all the payroll, the interest that is supposed to be paid to the bank, a business would have borrowed some kind of goods or service and they promise to pay after 21 days or 30 days. In accounting jargon, that is called as credit term. So all that would be recorded under current liabilities. Currently, business is liable to pay someone. So all the money that is supposed to go out of the business within one financial year would be recorded under current liabilities. Now let us see what appears under assets as current assets. Mainly it is made of three things: debtors, inventory, cash in hand, and cash in bank. Debtors are people who owe money to the business. Inventory are nothing but raw materials that are yet to be converted into finished product, or finished product that would be sitting in the warehouse that is yet to be sold. Cash is nothing but money that would be within the business or that would be deposited in a bank. Friends, this is all you need to know when it comes to balance sheet, the main heading, the basics that you need to know when it comes to balance sheet. It has got two main headings: liabilities and assets. As the word liabilities means liable, businesses liable to pay someone because it has borrowed something from them. And when that borrowed component money is being used in acquiring land, building equipments, and so on, that would be under assets. Any questions so far? I'll give you a few seconds for you to digest. If you want to take a screenshot, you're more than welcome to take a screenshot. Some of you are giving thumbs up, so I assume everything is fine and clear. So let me continue. Now let us go to the second part of this webinar. Why balance sheet is prepared? What is the purpose behind it? Now let us understand again from a layman perspective. Imagine this is you, as I mentioned before. You have $10,000. You also have a friend, and that friend of yours has also got $10,000. Now, both of you are thinking of somehow making more money with the money that you already have. So you try and come up with a lot of business ideas, but we are living in a world of instant gratification. So you decide, hey, the best way to double or triple or have multiple ways of increasing our profit is by gambling. So you decide to go to casino. And when you go to casino, there are so many opportunities out there. And let us imagine you have never been to a casino and you don't know how to gamble. When you and your friend are a bit worried and you are scratching your head, a person approaches you and says, "Hey, my name is Joe and I'm one of the best gamblers in town. I can take your money and gamble on your behalf. And I will give you two options. Option one, and my return on investment on an average is anywhere between 30 to 50%. That's the success rate that I have got so far on my return on investment." Joe gives two options. Option one, he says, "I will give you a guaranteed 10% return on your investment." Or another option is, "We will equally share if I win. If I don't win, then the money that I would have used, which is borrowed from you, would be lost." So there is a risk factor with option A. However, the profit margin would be really high if I win. Now let us imagine Joe has this two option in front of you. Which option would you go with? Would it be A or would it be B? Some of you are saying A, most of you are saying B. Again, I understand there will be a lot of ifs and buts involved. Just for the sake of this argument, would you go with A or B? Let us imagine most of you decide to go with option A, which is, if Joe, the gambler, wins, then the profit will be shared equally. If Joe loses, then you will walk out with no money. That's the option that you go with. However, your friend, let us imagine your friend is a bit conservative and is not ready to take risk. So your friend decides to go with option B, which is guaranteed 10% return. Now, first, Joe takes money from your friend and he starts gambling. First, it's your friend's money. After an hour, Joe is able to generate 20% return on the money that he has borrowed. Obviously, your friend is excited because your friend is able to get 10% guaranteed return. After second hour, Joe is able to generate 5% return. Now your friend is bit worried because the question that would be running in your friend's mind would be, what if Joe starts losing and what will happen to my money? How can I recover my money? After third hour, Joe is minus 10%. Joe has lost, not only lost the money that he has borrowed, but also he's making a loss. What do you think will happen at this stage? Obviously, your friend is a bit worried and your friend wants to come out of the contract, pull out the deal. Now let us imagine now Joe, the gambler, has taken money from you, which is $10,000. After an hour, Joe is able to generate 10%. Well, you will think this is the first time, it is still the first hour, so you're fine with it. After the second hour, Joe is able to generate 25% return. Now you're excited simply because you have got into an agreement where profit will be shared equally. After 3 hours, Joe is able to make 30%. Now, what would be running in your mind? Obviously, you will be thinking, I am making a lot of profit, so probably I would invest more on Joe. Friends, this is pretty much the approach most of us take in business. But unlike gambling, we don't have to approach business as a gamble. Unfortunately, many people do, but we don't have to approach business as a gamble. That is the reason we have all financial reports in front of us before making an informed decision. Now, let us take casino out of picture and let us bring business into the picture. And let us take out Joe out of the picture and let us imagine or let us put your business or a business that you want to start in shoes of Joe. Again, in business, there are two options. One, before the two options, the return on investment is not always confirmed. It is something that is expected, and that's the reason we come up with forecasts, we do budgeting, we do business planning. And the business says one of the option is guaranteed fixed return, and another option is equal share in the profit. People who decide to go with the first option, which is equal share in profit, are called insiders. As I mentioned previously, insiders are people who are ready to take the risk. And if the business ends up with a loss, they will take it with a pinch of salt because they know that is the deal that they have entered into. However, if business makes profit, they will demand an equal share in profit for the risk that they have taken. And people or parties that decide to go with option B, which is guaranteed fixed return, they are considered as outsiders, and predominantly it will be financial institutions like a bank. In business, instead we will not be measuring on an hourly basis. In most of the cases, it would be every financial quarter. You will be seeing the performance. If the performance is matching or meeting your expectation, then definitely you will be interested to invest your money and continue. Now, why balance sheet is prepared? And let us see who are the people who will be interested to read the balance sheet and what is that they will be looking on a balance sheet. Owners or shareholders who are considered as insiders, they will be looking for financial information of a business to make sure whether they want to leave the money behind within the business or should they be taking out of the business and investing somewhere else. Lenders, they will be looking for debt taking ability by the business. Has the business got more ability to take loan from them, or has the business got the ability to repay the loan that it has already borrowed from them? Again, banks, they make money by giving loans to people. So obviously they look into a balance sheet to know if a business has the ability to take more loan. Then the management, they will be looking for information to make future plans and accordingly take actions. Investors, who are considered as insiders, they will be looking for return on their investment. They estimate and evaluate to leave the investment behind or not. Now, investors invest only if they believe a business can help them make more money using their money than they would have done with their own money elsewhere. They are always looking for opportunity cost. And if they think this particular business has got the ability to give them good return on their investment, then they will invest more in this business. Employees, they are looking for the profit figure and growth. Why? Simply because they want to know whether they will be getting bonus incentives, promotions, and that is all based on how a company is performing. Then we have customers. They look for sustainability of the company. You wouldn't buy a company that is about to shut down, because you know if you buy a product or a service from such kind of a business, then what will happen after sales? Who is going to service if something goes wrong with that product? As a supplier, they will be looking for the viability. Will their money be paid on time? They would have supplied goods or service to that particular business. They are creditors. So they will be expecting their money to be paid within the credit term. So they look into a balance sheet to make sure if the business has the ability to pay them on time. So this is the main reason balance sheet is prepared, and different stakeholders that you can see on the screen will have their own vested interest to understand the numbers. Then finally, we have the government, and they are looking for info to calculate taxes, subsidies, and other incentives so that they can create a better environment for businesses to be more profitable. I'll give you a few seconds to go through it once again, digest, and if you have any question, please feel free to ask me, and I'll be more than happy to answer it for this particular sector. Meanwhile, I just want to quickly check if the internet, my voice, the video is clear. If you can hear me clearly, if the voice is audible and everything is fine, please type in yes. That's good. That's good. Good to know everything is going smoothly. Okay, let's continue. The last part, or before the last part of the webinar, balance sheet is also referred as asset and liability, statement of assets and liabilities. It is also referred as A and L statement. Doesn't matter what name they give to a balance sheet, all you have to understand is there are two main headings on a balance sheet, which are liabilities and assets. Now, if you take a look at any balance sheet, if you pull out any balance sheet, you will see the heading which reads balance sheet as on, which means it will say balance sheet as on a particular date. If it is prepared today, it would say balance sheet as on 18th August 2016. So it means all the validity of every item on the balance sheet holds good only on that particular date, not a day before, not the day after. It gives a snapshot of a business on that date. Just imagine bringing in all the liabilities and assets in one room. Just imagine having all your liabilities and assets in one room and asking them to freeze and smile and you take a photo. That is a balance sheet. Balance sheet is a snapshot of a business on that particular day. Let me continue. The final part of the webinar, which is what to see in a balance sheet. What are the four key things that you as a business owner, that you as a key decision maker should be looking at? As I mentioned previously, balance sheet has got two headings: liabilities and assets. Liabilities, you have insiders money, which is share capital, and outsiders money, which would be under loans. When that money is used in acquiring land, building, equipments, and so on, they are considered as fixed assets. Sometimes business will not borrow physical cash, but it will borrow its kind. All the current liabilities. Currently, business is liable to pay someone. All the money that is supposed to go out within one financial year would be under current liabilities. Similarly, we have current assets. As I mentioned previously, it is made of three things: debtors, inventory, and cash. I further simplify balance sheet into four categories. Share capital and loans are considered as long term liabilities. Anything that is more than one financial year, any commitment that is more than one financial year is called as long term. In this case, share capital and loans. People invest in business not to make money overnight. Well, that might be something that most of them would like to do, but however, business owners, investors, they invest in business not to make money immediately, but they will park their money, invest their money for more than a year. Even banks, they don't give loan, business loan, for anything less than 1 year. If at all it is less than 1 year, it would be under current liabilities as working capital. So share capital and loans are considered as long term liabilities. Current liabilities are considered as short term liabilities because the commitment of money that is supposed to go out of the businesses within one financial year. So that is the reason it is considered as short term. Fixed assets are considered as long term assets. People buy assets not to use it and throw it away within a year. Building, office furnitures, equipments, vehicles, they're all purchased to be used for more than a year. So that is the reason it is considered as long-term assets. And all the current assets, which is inventory and debtors and cash, are considered as short-term assets. The rule of thumb while borrowing says life of a loan should be equal to life of an asset. I repeat, the rule of thumb while borrowing says life of a loan should be equal to life of an asset. Going by that rule, long-term liabilities should be invested in long-term assets. Short-term liabilities should be invested in short-term assets. Now let me give you an example. Imagine you want to start a cafe and you need a coffee machine. The rule of thumb says if you are going to use the coffee machine for 3 years, then take a loan for 3 years. As and when you're making coffee and selling to customers and the customers are paying you money, part of it pay to your lender, so that after 3 years the coffee machine becomes your asset. Another example, if you decide to start a taxi business, the rule of thumb says take a loan for 5 years if you think you are going to use the taxi for 5 years. As and when you're picking the passengers and dropping them, part of it pay to your lender, so that after 5 years it becomes your asset. So going by that rule, long-term liabilities should be invested in long-term assets and short-term liabilities should be invested in short-term assets. However, there are no ideal situation business. I'm sure you agree with me. 1 plus 1 is never equal to 2 for a business person. The potential client who will say or who will promise to give you business next week might end up giving business after a month. The debtor who is supposed to pay you within 30 days might end up paying you only after 30 days. So, what I'm trying to say is there are no ideal situation in business. In that scenario, it is acceptable to invest long term liabilities into short term assets. Friends, the reason I'm using the word acceptable is simply because these long term liabilities, these long term lenders will come knocking the door for their money after one financial year. If their money is used in acquiring is used in for short term purpose, business will have the cash to pay them after a year. However, this is a big mistake, and I consider it as a crime in business when people in business are using short term liabilities for long term purpose. The reason this is a big mistake is simply because these short term lenders will come knocking the door for their money within one financial year. If their money is used in acquiring long term assets, business will not have sufficient cash to pay them on time. In that scenario, business owner has to pump in more money to keep the ball rolling, or business will approach banks and banks will not be happy to give them more loan, or else business will end up selling fixed assets to pay the bills. And selling the fixed assets to pay the bills is beginning of an end. It is called burning the furniture. This is one of the big mistake businesses do. And this is just matter of time before business gets into cash flow issues. So, as a business owner, as a key decision maker in your business, the four key things that you have to look into are long term liabilities, short term liabilities, long term assets, and short term assets. As far as possible, try to use long term liabilities for long term purpose. It is okay to use long term liabilities for short term purpose, but never ever use short term liabilities for long term purpose. For you, for you to know whether you're committing this mistake or not, you have to make sure your bookkeeper or accountant is preparing the financial report and it is up to date. And those numbers should always be in front of you before you make any financial decision. Friends, at this stage, if you have any question, please feel free to ask. I'm happy to answer, or else we will move on to the next slide. Looks like everything is fine. Some of you are giving thumbs up. That's good. Now, let us do a quick recap. What did we learn today? The first part was on the question, what's on a balance sheet? As I told you, the key thing here is to understand you are not your business. Balance sheet is prepared from business perspective, not from business owner's perspective. So looking from a business perspective, when business needs money, it borrows. First, it borrows from insiders, and that money is called share capital. It would be recorded as share capital under liabilities. And the money business borrows from outsiders are considered as loans, and it would be recorded again under liabilities. When the borrowed money is used to acquire land, building, equipment, and so on, that would be under fixed assets. Sometimes business will not borrow money It will not borrow physical cash, but it will borrow goods and services. And it would say, I would, and it would promise to pay after 21 days or 30 days, depending on the credit term agreed upon. And that would be recorded under current liabilities. Currently, business is liable to pay someone. Similarly, we have current assets mainly made of three things: debtors, inventory, and cash. Debtors is nothing but money that is supposed to come into the business. Inventory is goods that are yet to be sold. And finally, cash in hand, cash in bank. In the second part, we learned why a balance sheet is prepared. As I told you, people who have invested in business or people who have given money to the business, people who are part of the business, they want to understand what is happening within the business. For all the stakeholders to be part of the business, they want to know where the money came and where it went and how well the business is performing. And finally, the four key things we learned that we have to look in a balance sheet. They are long-term liabilities, short-term liabilities, and long-term assets and short-term assets. Long-term liabilities should be used for long-term purpose, and short-term liabilities should be used for short-term purpose as far as possible. It is acceptable to use long-term liabilities for short-term purpose. However, business should never use short-term liabilities for long-term purpose. Friends, finally, I would like to thank you for attending this webinar and participating as well. This webinar will be recorded and it will be made available on YouTube. For more details, please visit the website www.ssba.net.au. You will find many informative articles and also previous webinars that you can access. And this particular Smart Connect forum has got amazing speakers and experts, and some of them you can see here. And their expertise is in sales, marketing, customer service, leadership, planning, and so on. Uh, if you want to know more about what I do, please visit my website, financeacademy.com.au. My book recently became Amazon's bestseller. So if you're interested in purchasing my book or getting more information about what is that I do, please connect with me on LinkedIn. There are many amazing articles, as I mentioned before, on ssba.net.au. Please access it, educate yourself, and let us all become smarter business people. I will be still online for next few more minutes, so feel free to drop in any question. I'm more than happy to answer it. Or else, thank you so much for being part of the webinar. Have a wonderful afternoon and please take care of yourself. Thank you. Okay, then looks like no one has questions for me and all of you are giving thumbs up. Thank you so much. Had a great time presenting this webinar and I look forward to presenting it next month as well. Thank you once again and have a wonderful day.